Hi, I'm Ross Mayfield, investment strategist at Baird, and today we are here for a special video with Strategas chief economist Don Rissmiller. Don, we have gotten a lot of questions as this tax bill has moved through Congress about the national debt, about the impact on the deficit, and what that might mean for our investors. You did a very helpful video last year where you laid out a couple of key things for investors to keep an eye on. So I wondered if we could talk a bit about that. And I want to start with, you laid out a couple of key considerations for when the debt becomes a problem. We know it's a big number, but the question is, when does it become an issue, or what are the set of circumstances that lead it to be an issue? You outlined a few things. I wondered if you could expand on them. Whether the debt is denominated in the currency of the issuing country, whether foreigners own the debt, and what the level of the interest rate is on the debt, and in particular with relation to GDP. So those are three things, but if you could expand on each of them a little bit and let us know where we sit today, I think that would be a helpful place to start.
Yeah, Ross, very good to talk with you. Happy to be here with everybody. So when we look around the world, you get in big trouble when you have debt that's not in your own currency and owned abroad. And so those conditions don't apply universally to the US because we have debt in dollars. Now, we do have debt that's owned abroad. So there is some reason for concern, but the question is the concern an emergency or not? And I would understand why, especially over the next few months, this is going to come up, because we're going to work through the tax bill, we'll work through the debt ceiling, we'll work through some liquidity issues. So over the next several months, it is perfectly reasonable to be talking about whether there are bond market vigilante-like responses that we have to be concerned about. So the budget constraint I would give you is that debt relative to income has to go sideways over a long period of time. And so right now, if we look at the US, we would use debt to nominal GDP as our metric, and that's going up. So if you have your debt relative to your income going up indefinitely, some year you're going to come in and the interest costs will consume your entire budget. So you don't want that. So the budget constraint we're trying to satisfy is to get debt relative to GDP to flatten out. And so if we operate in the numerator of that equation, we're talking about the deficit, we're talking about the annual addition to the debt, and that really is a function of taxes and spending. And in terms of the deficit reduction, I don't see a lot that's moving right now that's going to make significant difference in the medium term. So that pushes us into the denominator, nominal GDP. We would break that down into real GDP and inflation. Real GDP we could break down into hours worked and output per hour, getting us to output. And hours worked we could proxy with population growth. And so we have in the denominator the population growth, productivity, and inflation as our three variables, our three levers that we could work with. If we look at the current policy as it relates to the border, I would not bank on population growth to be the way out for this equation. So now we've crossed off taxes, we've crossed off spending, we've crossed off population growth as things that are really going to help in the medium term. That leaves inflation and productivity. And I think that's how we're going to have to judge the next several years. It's going to be a race between those two. If we have an expanding deficit, an expanding debt to GDP ratio, the risk is that we're going to see a return of inflation. I don't think this is immediate. I think there are a number of things that can be done in the very short run, but the hope is that the private sector can help bail out the public sector here by improving productivity. So we have the debt we have. Can we get productivity to increase? Can that make GDP bigger? And then the debt relative to GDP ratio can start to flatline. That's the budget constraint we're trying to satisfy so that the concern does not become an emergency down the road.
So that was a really thorough answer. I want to pull at just a couple of threads. The first one, I think the debt being denominated in our own currency makes this, for our country, for the US at least, different from some of the other country comparisons or some of the obvious debt crises that we've seen over the last 20, 30, 50 years. Can you talk about the importance of that? And then if the, that's not the constraint, then would it be, hey, we have the printing press, but then if we, print indefinitely to satisfy our debts, does that lead to inflation down the road? Is that the thing to be thinking about? And if so, is it inflation we should actually be watching?
Yeah, Ross, I think that's correct. So the debt is denominated in a currency that the U.S. can print. And this is not always the case. And so you could think about an economy abroad who issued debt in dollars, or you could think about an economy abroad that's part of a currency union where they don't control the printing press precisely. But the U.S. can print dollars. We can pay the dollars that the debt demands. What we can't guarantee is what those dollars buy. And so the relief valve will come down to what the longer term inflationary picture looks like. So I don't think it'll be a crisis or a failed auction. It would be whether those dollars that you get as an interest payment start to buy less and less over time.
And then the other item, and I would note that is the thing that makes this also a distinctly different conversation from, a personal budget or a company. I think often the two are conflated, but, companies and consumers don't issue their own currency. So it's not really apples to apples. The other thing is, so, we've seen debt to GDP this high before, post World War II. And the answer there was kind of something you mentioned earlier, which was we kind of just grew out of it. Now we had a big population boom then. So that's the part of the equation that we find ourselves struggling with today, given the demographics and the policy choices. So the other item is productivity. And I think there's a lot being laid at the hope of productivity's feet, and particularly the hope that AI and some of these technology enhancements can really generate a sustained boom in productivity that can grow GDP and kind of grow our way out of this. Are you seeing evidence of that yet? And what should we be watching over the next couple of years to see if that's a story that's starting to play out or not?
Yeah, Ross, this is critically important because if we're trying to combine hours worked and output per hour, it doesn't look like we're going to get a big expansion of hours. So it has to be the output per hour, the productivity variable. So what we're trying to achieve is, instead of having too much money chasing too few goods, we want to up the goods to balance that equation. So take the factors of production we have and get more out of them. That's another way to chop off any second wave of inflation. That requires some of the productivity stories that we know about, whether it's AI or technology, to contribute to getting output per hour up. The big tell I would look for is that it has to be the producers of the technology and the users of the technology that are both profitable at the same time. And I think that's the missing element right now. We know the producers of some of the technology have seen profits expand. We know we're buying the chips, as an example. We need a non-tech company to report earnings and say, because I have access to this new item, this new technology, my profits are up also. So it'll be a combination of getting producers and users of new technologies to both be profitable at the same time. I think that would be a telltale sign that productivity is improving and that AI is working in the way we want.
That makes a lot of sense. So let me end here with the final question, because ultimately it comes back to the question we get all the time is, when does this become an issue for investors? We talked about some of the reasons that it's not an immediate issue, but some of the issues down the road. What would you be watching to say this is now becoming a critical issue for investors, maybe particularly for fixed income or treasury investors, but what is going to be one of the tells that we're at an inflection point? Because, we've heard about the debt for years and years and decades, and as of yet, we haven't really seen it spill over into the equity market. What are you watching for, or what would be a tell that we're at some sort of inflection point?
Yeah, if over the next few months we started to see, let's say, the 10-year Treasury rise towards 5% in its yield, I think that would start to spook people. Now, if you get that, I would think that there will be a reaction. And so part of the reaction could be by the government to look at different rules like the supplementary leverage ratio. We could start talking about Treasury buybacks. There are still some tools that can be used to manage those type of bond market moves. If we run out of tools, that would start to be a problem. So can we get to a situation where we're really backed into a corner. I don't think we're there yet, but let's keep monitoring that. The other would be if abroad, where we have countries with even higher debt to GDP ratios like Japan, we start to see some reaction. So if this is going to be a problem in the U.S., it may not be the U.S. first, and we can monitor what's going on elsewhere to see how significant of an issue this is.
That's a good point. I'm glad you ended there. We often focus on the U.S. debt, the U.S. deficit, as if we're the only country in this boat, and that is far from the case. There are plenty of other countries dealing with this on their own terms and potentially with less tools in the toolbox. So, Don, this has been really useful. I'm sure it'll come up again, so we'll lean on you for your insight. But thanks for the time today.
Happy to talk with you, Ross.